The way I refer to it is often it's a shadow tax. It's not something we feel when we file our tax return, but we get a lovely bill 2 years out that says, hey, because your income went up.
And then you get a phone call that says, what in the world did you do, Corey?
Yeah, so IRMAA is something we absolutely have to plan around. We're managing tax rates, but we're also managing those Medicare premiums.
Starting your route to retirement.
Welcome to the Guided Retirement Show. On today's episode, I'm filling in for Dean Barber. Alongside Corey Hulstein, we talk about specific tax situations that we've helped clients out with over the past calendar year. Please enjoy my conversation with Corey Hulstein.
Before we hop into today's episode, I want to remind our listeners and viewers that you can access the same financial planning tools we use for our own clients on your own time and all from the comfort of your own home. All you need to do is visit the link in the show notes and click the Start Planning button. From there, you can start building your retirement plan, no cost, no obligation.
Welcome. I'm Logan DeGraeve, Certified Financial Planner here at Modern Wealth Management. Today, we have Corey Hulstein, Director of Tax here in studio. How you doing, Corey?
Doing good. Thanks for having me today.
Absolutely. So we thought that we'd kick Dean out today because part of what Corey and I spend a lot of time doing here is working with clients on their individualized tax plan. And we get a few stories that we want to talk about. But before we maybe start with this, Corey, set the foundation of what tax planning is and why we even look at it.
Yeah, so effective tax planning is trying to minimize your taxation over the course of your lifetime, or if it's important to the client, over the dollar's lifetime. So as it passes to the next generation, making sure that at each level, we're paying as little tax as possible over the course of that duration of time.
Yeah, and I think, Corey, that the biggest thing that a lot of people need to understand is their investment advisor, even their certified financial planner, they have an idea about taxes, okay? I've been humbled a number of times in meetings with you because there's things that you just think about that I don't because we have different perspectives. So we're going to hop into a few stories here, actual client situations that we've probably worked on in the past 12 months. And, the first one has to do with college credits. And it was a situation where this client still has some kids that are finishing up college. From my perspective, it was going to be, let's speed up income because we're in these lower tax rates today because we haven't started these required minimum distributions, right? So let's be, maxing out the 22% bracket hypothetically. But you stopped me, right? Why did you stop me on that situation?
Yeah, so in this particular client, again, with the kids in college and the ability to manipulate income in retirement, we actually had an opportunity to attain some college credits for this particular client. So the college credit phase out happens at around $160,000 of adjusted gross income. And again, if we're looking at maxing out that 22% bracket, we have the ability to go up to around $200,000, $220,000. So in this particular situation, by adding additional income through that Roth conversion, yes, while it's at a 22% effective rate on the for the marginal rate, the problem was the effective rate was significantly higher.
Well, it was about 34%.
It was about 34% because of the opportunity cost of sacrificing that college credit.
Yeah. So, but one, there were two things that allowed us to help this client. One was looking at long-term tax plan, right? Having that financial plan built to look at it. The second thing was making that individualized tax plan for the year 2023. So, Corey, when you're sitting down with people, how do you use the financial plan as a guide? And that how did that lead us to the decision we made for this client?
Yeah. So first step of building an effective tax plan is understand where we're at today relative to where we're going to be at in the future, right? And in order to do that for a lot of our retirees, it's building out that financial plan. That financial plan says, hey, here's all the assets. Here's what spending is going to be over a long duration of time. How do the tax rates fit into that long-term plan? So the plan provides the context of how we make these decisions. And from there, the tax or the CPAs, they need to look at this from a holistic approach. There's so many loopholes or gotchas in the tax code that you need to be aware of. And someone in your shoes, Logan, you have a lot of other things on your plate. You can't spend a significant amount of time just living in that world.
Well, and I say this too. You want a team of professionals that's what they do. Right? My job is in the financial planning and the investments. Your job is in the taxation piece, because it's the same thing even with Medicare and insurance planning. The tax code, Medicare planning, all that stuff changes. right? It's hard to be really, really good at about 10 things, right? You can be really good at 2 or 3 things, and that's why we put a team in place. I think it's important, though, as we work through some of these examples, that we start with something at the front end of the show that's not just for the retiree. And this is a number of examples, but a lot of times people think that, hey, look, I'm working, I have W-2 income, I'm in the 24 or 35 or 32 whatever percent bracket. There's not a lot of tax planning that needs to be done. And I would say sometimes you are correct, depending on what your goals are and what you're looking to do. But Corey, let's talk about a particular example with a client that is in a high tax bracket today that we know is going to be in a lower tax bracket in the future. So things like Roth conversions aren't the focus, but what would be the focus and for someone like this?
Yeah, so the focus on a client in this situation is, A, where are we saving funds to? So are we saving to a traditional 401k or a Roth 401k? What does our non-qualified or brokerage accounts look like? Do we have a way to start accumulating some funds in those accounts to create flexibility when we get to the point of retirement? But there's also some charitable donation strategies we could look at as well for those who have that as a desire for them. So certain situations we've looked at, people who are approaching retirement, they're at the highest phase of earnings they've ever been at. And those rates are likely going to be higher than those early years of retirement. Mm-hmm. So we've looked at certain strategies to say, hey, if we can, group several years of donations through a donor advised fund into 1 year, we're allowed to deduct those then at the high tax rates. And in the future years, no, we're not getting deductions for those charitable donations, but we already deducted them at 35, 37% tax rates. And in the following years, we'd be at 12, 22%
And that's
rates.
the great thing about a donor advised fund, because it gives the person the ability to take advantage when they're in these high tax rates of getting some of the deductions, but we can still give from that fund in the lower tax rates. You say this all the time. You don't give to charity to save taxes. But what our job is to ultimately maximize what you are doing there. Anything else from a charitable giving that you can think of that clients should be thinking about?
Yeah, QCDs obviously come to play. So QCD is a qualified charitable distribution. That's where we can take funds directly out of the IRA account, give them directly to the charity. Nobody in that transaction pays tax on the funds that went out of the IRA account. It is only available for people who are 70 and a half or older. So, in the fact pattern that we talked about here, a QCD could potentially make sense. In that fact pattern, it actually made more sense to go with the donor advised fund route. So it's important to understand what is the annual giving that we're doing, right? In today's landscape, from a tax perspective, it's hard to actually get a lot of value from the charitable donations. So there's a lot of different moving pieces here that you need to have the conversation with your advisor and your CPA about what's important to me, how much am I giving on an annual basis, and how do we structure these things? Again, not because we want to change your charitable patterns, but just because we want to maximize something you're already doing.
You mentioned when you started that, you're talking about, asset location, what funds you hold in what type of accounts. And that kind of leads me into another example. This was actually one of my favorite cases to work on, but this client had a lot of money in a brokerage account, right? A taxable account. And the issue with that, when you hold mutual funds, is something called capital gain distributions. Corey, explain what that is and why that becomes a problem before we kind of hop into what we did.
Yeah. So let's set the stage of what is a mutual fund. A mutual fund is essentially a collection of stocks. It's very similar as an ETF. The large exchange traded fund. The large difference there is there's an actual fund manager pulling the levers behind the scenes. And by that, I mean...
It's actively managed.
It's actively managed. The fund manager is moving in and out of certain positions in order to achieve the goal of whatever that mutual fund is set to do. Well, we know that every time we sell a stock position, we're either going to have a capital gain or a capital loss inside of a brokerage account. So at the fund level, they are continually moving in and out of positions, but who pays the tax on that transaction? Ultimately, it's the owner of the mutual fund.
And remember, we're talking in a taxable brokerage account, right? IRAs, Roth IRAs, you're fine. You could trade as much as you want in there.
Exactly right. So a capital gain distribution happens, generally speaking, in December, where they accumulated all these gains and losses throughout the year at the fund level. And what they do then is they distribute all those gains and losses out to the owner of the fund. And so what happens from a tax perspective in a brokerage account is we get this large capital gain distribution that we weren't anticipating, or we have no real way to value throughout the year. We usually get data on these things around October and November, which creates a small window of opportunity to try to capitalize on these things, but it's not something we can actively plan around in January, for example.
Well, in this particular client, the issue was a couple things. One, we were trying to do effective tax planning, but they were kicking off somewhere between $70,000 $100,000 a year from capital gain distributions, and that was too much variability for us to feel comfortable with the tax plan. The thing that we did for them, though, they've been a client for probably 4 years or so now. We know that long-term tax rates are a big problem for them, right? But they've done such a wonderful job saving to different buckets. So they have a lot in the taxable, the brokerage, the tax deferred, and then the tax free. So we knew that, hey, look, we're going to do these large Roth conversions initially, okay? But then something happened. We had to go out and find health insurance, okay? And we're talking about pre-65 health insurance. And we knew that it would be impossible to get any level of decent premiums if we still had these capital gain distributions, because that would toss them over the income thresholds. And I'm going to let you talk about this in a second. But what we did was say, look, there's going to be a year or two of pain. And they had a lot of pain. They paid a lot of money in taxes. And part of what we did was trade funds, a mutual fund for an exchange traded fund. Now, the timing of it was good. Hopefully the market holds up here. But explain why income matters to the person that's pre-65 that's looking for health insurance, because I think this is critical, because there's a big stigma around you can't retire before you're 65. And I think that's something that robs people of a lot of precious commodity of time. And so how can you retire pre-65?
Yeah, so what Logan is referring to is Affordable Care Act insurance, often referred to as Obamacare. And the way this program works is your health insurance premiums are going to be dictated by what your level of income is. And income, what I mean by that is what shows up on the tax return as income. So in this particular situation, again, with a high level of brokerage funds, we're able to access those funds at a low tax ramification. So we can meet all of their daily living expenses at essentially no taxation. So in this particular client, the variability of the income from the capital gain distributions was going to be, again, $70,000, $100,000 a year, where we have no control. And what that does is not only are we paying tax on those funds, but we're also driving up the cost of our health insurance. So for anyone out there who's listening that's looking at retirement before 65, this is a complicated area of tax law, and it's something that's going to be moving over the next few years, but it's important to know there's options out there. And before we get to retirement too, Logan and I have done this with other clients as well. If we don't have a lot of flexibility in the accounts, how can we create that flexibility to achieve retirement at 62, 63 before we get to the actual retirement date?
So what you're saying is that to set the chessboard to have a successful retirement pre-65, potentially you need to be thinking when you're in your 30s and 40s of how you're saving today and tomorrow, right? To have that flexibility.
Yeah, and remember, we meet people where they're at. So if we can get a year or two of planning done beforehand, before that retirement date, there's some possibility we can still make that happen for a particular client. You know, one of the clients we've worked on, we didn't have any flexibility in the account. Essentially, all the funds were saved to IRA accounts, meaning every time we take a distribution to meet our daily needs, we got to pay tax. That's income. That's going to drive up the cost of the health insurance. The trade-off for this particular client is let's do conversions while we're still working. Not normally the strategy that we're looking to pursue, but what it does is it creates a lot of cash that we can live on, and we paid tax at 22%. But what we're doing is now we have access to these funds to live on in those ACA years, keeping the cost of health insurance significantly lower.
I want to make a point, though, with this ACA health insurance, and this is too complicated to do on your own, right? This is a very, very complicated. You need the help of a CPA and a certified financial planner in conjunction, because oftentimes what's best for you from maybe a health insurance perspective or even a tax perspective or where you're going to draw money from one of those things may not be the best, right? But how do you compromise that plan to work together? And don't just say, hey, I'm going to work till 65 because my buddy said that, healthcare premiums were $2,000 a month for, the family. That could be the case, and we've seen that. But the reality is there are some things around that. The second thing I want to talk about with capital gain distributions, and the thing that drives me nuts about them, and a lot of people that are listening probably had this happen last year. You probably lost 20, 30% in these equity type funds, maybe more if they were tech heavy, 35. And then you had to pay tax on, in this particular example, maybe $70,000 of capital gains. Corey, why does that happen? How does that make sense?
It makes sense because, again, it all depends on what happened at the fund level. If the fund manager got out of certain positions before the market went down and reallocated, you probably still lost money based on, just the movement of positions. But what it did is it incurred the capital gains. So it's a nightmare scenario for a fund manager and a taxpayer, but we see it all the time.
Yeah. Let's talk about another situation that we had recently. We weren't really planning on talking about this for this podcast, but I think it's critical. So a lot of people think about, hey, I'm going to leave my money to my loved ones, and their goal is to be as tax efficient as possible. But sometimes there's a trade-off, Corey, and you're going to talk about this here in a second, between being what is known as tax efficient as possible, but also exercising control to your loved ones. So what I mean by control is saying, hey, look, we don't want the IRAs to go outright to the beneficiaries where they can access the money, day one, and it has to all come out in 10 years. We're worried about lifelong income for these beneficiaries, whether it's just because you worry or they giving you a reason to worry or, you're just not sure. And that's a critical piece. But Corey, the issue with this is when you name a trust as the beneficiary of an IRA, instead of having to come out in 10 years, right, it has to come out over a 5-year period, and it takes hardly any income, I believe around $15,000, to get to that ultimate highest tax bracket. So explain that situation in a little bit more detail and kind of how we're going to have to maneuver that.
Yeah. So like any area of life, taxes is a series of trade-offs, okay? And when we look at estate planning and how we structure the control element versus the tax element, there's going to be a trade-off with these two components. So when we look at when the trust inherits an IRA account, that means the IRA funds are going to go to the trust level. Inherently, what the trust is trying to do in this situation was to control how much income the beneficiaries could receive on any given year. This particular person says, hey, I don't want my children or heirs to just go out and stop working and live off of my funds, right? Or go buy the new Corvette or whatever it is.
Because, hypothetically, Corey, you could inherit an IRA. Day two of inherit it, you could take out the whole account.
Correct.
Right?
Yeah. When an individual receives a beneficiary IRA, there's no restrictions. They own those funds at that point. Whether it's in their best interest to distribute it on day one, it's probably not, but they have complete control to do so. Where the trust component allows the decedent to essentially control how the funds go out to the beneficiary. Mm-hmm. So in this example, let's say there's $1 million of IRA funds left. Again, instead of a 10-year rule, we have a 5-year window now to distribute the funds to the trust. This stuff gets complicated, but at the heart of it, now instead of a $100,000 distribution each and every year to the beneficiary level, we have a $200,000 distribution to the trust level. And like you said, Logan, the trust rates get high quickly. So the top tax bracket is around $15,000 of income at 37. Anything over that is taxed at 37%. So the way trust taxation works is essentially we can take the tax and pay the tax at the trust level, or we can send the beneficiaries the cash and pay the tax at the individual level. Well, if we have the restrictions on how much the beneficiaries can receive,
right,
that means the trust has to retain the income and pay at those top tax rates.
But I think let's kind of take a step back here, because in this particular situation, what Corey's saying is, hey, look, there's nothing wrong if you want to exercise control, okay? The trade-off with that is we're probably not as tax efficient as we could be. So I enjoyed this meeting because it was, hey, look, we can't have our cake and eat it too type of thing. But what we can do is, if control is the most important thing to you, no problem. That's great. But let's look at maybe changing the tax plan that we would have moving forward. So what I mean by that is, let's look at doing maybe larger Roth conversions, having mom and dad pay some tax now at, 10, 12, 22%, okay, versus the paying at the trust level in the future. So yeah, are we going to probably get all the IRA money over? No. But the reality is we're going to be able to make a good dent. So that kind of changed the conversation from, hey, look, we wanted to stay in the first IRMAA, and I'll let you kind of explain that here too. Maybe we look at going to the second or third IRMAA because effectively these rates aren't near as high as what they could be if we stay at the trust level. Explain IRMAA and what you have to look at there.
Yeah, so IRMAA, lovely friend IRMAA, is income-related monthly Medicare adjustment. And essentially what that means is if your income crosses over certain thresholds, the first one being right around $200,000 of income, they are going to charge you more for the same exact coverage of Medicare as everybody else. It's just it's the way I refer to it is often it's a shadow tax. It's not something we feel when we file our tax return, but we get a lovely bill 2 years out that says, hey, because your income went up.
And then you get a phone call that says, what in the world did you do, Corey?
Yeah, so IRMAA is something we absolutely have to plan around. We're managing tax rates, but we're also managing those Medicare premiums. To go back to something you said too, Logan, it's incredibly important that our clients are communicating with us what it is the desire is. Because in this particular example, we were looking at going to first level of IRMAA. Yeah. We didn't want them to pay more in Medicare premiums because we didn't see the need for it. Well, when the client says, hey, my IRAs are going to that trust account, we don't know when date of death is obviously going to be, so we need to start hedging against that 39.6% tax rate today.
Yeah. Let's talk about one last thing as we wrap up here, because I think it's important, and it goes into two parts, because you and I see this a lot with my clients, but you see this even with more clients, and it's something that is known as the 0% capital gains rate. And I'm going to kind of pair that with NUA, the clients I'm talking about. So talk about net unrealized appreciation, which is NUA. Talk about 0% capital gains rates and why some of this stuff matters and why it's an effective thing to look at for not only distribution planning early on, but long term. Give me a little bit of context there.
Yeah, so we're talking about a series of trade-offs today is the focus, I guess. So NUA is net unrealized appreciation. And essentially what it is if you're working for a public employer and they offer an employee stock option purchase plan, what it's allowing you to do is take money pre-tax and contribute to the stock of the company. And that money has obviously grown over time. Oftentimes, the employer will offer a discount on the purchase price. And if we've worked for an employer for 20, 30 years, that stock's probably increased significantly. So what we see a lot of is these ESOP plans, we have a very low basis in the stock. We've never paid any tax on the basis of the stock.
And basis is what you paid for.
Right, yep. And we've never paid any tax on those funds. And we have two options. When we retire, we can either roll those funds over to an IRA account, because again, this is pre-tax money, or we can make an NUA election. And what that NUA election does is we roll the funds instead of to an IRA account, we now roll it to a brokerage account. Why would we do that? Because we know that every dollar we take out of an IRA account is going to be taxed at your ordinary income rates. Where a brokerage account, we are subject to the capital gain tax rates, which are 0, 15, or 20% taxation. The trade-off comes to play here of A, what's the basis relative to the fair market value? And B, do we have a way over concentrated stock position now that's running your portfolio?
Right.
If I don't know if Target, for example, offers this program, but we saw what happened to Target a few months back, where stock price plummets. Do we want to be subject to that risk in an over-concentrated stock position?
Right.
So when we're looking at NUA, those are the factors we need to think about. And remember, we can't necessarily sell all of our Target stock on day one if it's in a brokerage account.
Right.
Because we're going to trigger all of those capital gains on the year of sale. Where in the IRA account, we don't have any problem just reallocating that position because there's no capital gains in the IRA.
Yeah. Let's take a step back, because to most listening to this so far, people are probably saying this is ultra complicated. This is tax planning for the ultra rich. I only have $1 million. I only have $700,000. This stuff doesn't matter to me. Corey, what would you say to that?
What I say to that is tax planning is critical. We're all tax-paying Americans listening to this podcast. It's always going to be a big piece of what we do. And taxes and healthcare, those are the two biggest wealth eroding factors in retirement. Can we eliminate taxes? Likely not. But it's important to pay as little amount of taxes over the course of your lifetime regardless, I guess, of what the actual dollars and cents are.
Yeah. So I think that the takeaway from today is that, look, you have enough money if you've saved that you should be expected that your investment advisor, your certified financial planner, is consulting with a CPA or someone that can look at the forward-looking tax plan. It's not for the people that have 10, 15, $20 million. It's just as important for someone that has $1 million, and maybe even more important, right, than someone that has $10 million. So we can sit down with you. We can go through your situation. Don't think you have to work till 65 because of, Medicare and those type of things. So Corey, I really appreciate you being on today. Hopefully that this was insightful, and look forward to the next time.
Thanks a lot.
Thanks for joining us on the Guide to Retirement Show. If you have any questions about your specific situation, feel free to reach out to us. We'll see you next time.
Don't forget, we're offering you access to the same financial planning tools we use for our own clients. Just get out to the link in the show notes and click the Start Planning button and begin your retirement plan from the comfort of your own home.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Modern Wealth Management, LLC, an SEC-registered investment advisor.